Traffic through the Strait of Hormuz has picked up and then fallen again. Oil prices, which had declined to about $70 a barrel earlier this month, have now rebounded to roughly $90. For the global economy, the war has disrupted supply chains and hurt incomes. At the same time, the artificial intelligence boom has delivered an offset with huge investments in data centers and elevated valuations for AI-related companies. Overall, world growth and inflation forecasts are largely unchanged since our last meeting. Among the major central banks, both the Bank of Japan and the European Central Bank raised rates at their June meetings, which was expected. Meanwhile, the Bank of England, the People's Bank of China, and the US Federal Reserve have been on hold. That said, Fed communications have emphasized the importance of price stability, and rates have shifted up significantly at the short end of the US yield curve. In this context, the dollar has strengthened against other major currencies. Moving to South Africa, first quarter growth was stronger than expected, running close to 2% year-on-year. However, this was due to higher net exports rather than domestic demand. We anticipate slower growth through the second and third quarters of this year. Consumer confidence has fallen sharply, and business confidence has also weakened. Sectoral data show generally lower activity since the start of the war. Prices for our export commodities have also fallen, although terms of trade are better, given lower prices for imports. We started this year with good momentum, but households have suffered from higher fuel prices while uncertainty has weighed on investment. It is also increasingly clear that municipal dysfunction has become a binding constraint on growth. With domestic reforms, we think the economy can get back to a rising growth trend as global conditions stabilize. Our baseline forecast is that the economy starts to recover in the second half of this year as the shock fades. But the outlook is uncertain. We see downside risks to growth. Turning to inflation, recent prints have been well above target, mainly because of higher fuel costs. Petrol and diesel prices eased this month, but global prices have now risen again. We expect headline inflation to stay above 4% until early next year. Aside from fuel, goods prices have been relatively contained. The exchange rate has been resilient, and the rand is close to where it started the year against the dollar, and it is now stronger against the euro. This has helped with import prices. Food inflation has also slowed recently. This reflects good harvests as well as fading effects from the outbreak of foot-and-mouth disease. El Niño may start affecting food supply next year, but this is still a risk factor, not part of our baseline. For services inflation, conditions look problematic, with most components now well above 3%, including insurance, transport, and housing. Our various measures of underlying inflation also indicate stronger inflation pressures. According to the latest survey from the Bureau for Economic Research, inflation expectations have risen. The changes are bigger for the near term than the longer term. All survey groups anticipated higher inflation, with the biggest change coming from trade unions. As for market expectations, break-even rates have eased since May, but they are still higher than they were at the start of the year. We see upside risks to inflation. Against this backdrop, the committee decided to keep the policy rate unchanged at 7%. 4 members preferred a hold, while 2 favored an increase of 25 basis points. The committee agreed that the outlook is uncertain, and with the rate increase at our previous meeting, the policy stance is appropriate for now, with rates somewhat restrictive. The forecast from our quarterly projection model shows the policy rate broadly stable through the remainder of the year. The model shows cuts later in the forecast as inflation falls to 3% and rates adjust towards neutral levels. As before, this rate path remains a broad policy guide, and our decisions will continue to be taken on a meeting-by-meeting basis with careful attention to the outlook, data outcomes, and the balance of risks to the outlook. To support our risk assessment, for this meeting we considered scenarios for inflation expectations as well as fuel prices. For expectations, after the upside surprise in the recent survey, we looked at what could happen if expectations keep on rising throughout this year. The scenario showed extra pressure on wages, which feeds through to core inflation. The model therefore sees tighter policy with one more rate hike than the baseline forecast, and rates staying higher for longer after that. For fuel, the recent volatility in oil prices shows that we face both upside and downside risks, depending on how the Middle East conflict evolves. We therefore considered an adverse case, with oil at $100 a barrel for 2026, easing slowly to $80 by 2029. That was paired with a positive scenario where oil is $78 this year, falling to $60 by 2029. The adverse scenario has inflation persistently above target, with the shock feeding through to food prices as well as core. This requires an extra hike this year and an extended period of restrictive policy. By contrast, the favorable scenario shows inflation returning to target more rapidly, implying that rates start easing in the current year. To conclude, the inflation outlook has improved slightly since our last meeting, but inflation is still too high while growth is weak. We are setting policy to achieve 3% inflation over time, ensuring the current supply shock does not de-anchor inflation expectations. At the same time, we recognize that South Africa's growth prospects will be driven mainly by domestic reforms. This covers structural interventions such as fixing local government and improving productivity in network sectors like transport and energy. It also includes the macroeconomic goals of sustainable debt and permanently lower inflation. Our main contribution is to stabilize inflation in line with our 3% target over time, and the MPC will act as needed to achieve that. That concludes our statement, and we will take questions from the members of the press. And as usual, please identify yourself and the house you represent, and we will direct your questions as appropriate. Kopan.
Good afternoon, Governor, and to the MPC committee. Inflation is now 2% above target. Well, it was in June. What gives you certainty that the last hike was enough to carry you through this cycle and to carry us into September in terms of inflation containment? Secondly, you revised inflation forecasts down at this meeting, even with the numbers looking the way they do. It went from 4.4 last time to 4 now. Why? Thirdly, core inflation appears to have been a bit unresponsive to your rate hikes to date. What more could you do to cool it? And lastly, do you expect a further rise in service inflation and subsequently core inflation in next month's print, given that that's when municipal rates for consumers would have been implemented? And if you do expect core to rise, what gives you confidence that despite this, inflation will still average 4% this year? Thank you.
I said I was going to take 3 questions, but you asked 3 questions, so let me deal with the 3 questions right away, and then I'll go to the next one. Inflation is 200 basis points above target. That is the last print. That is in the past. There is nothing we can do with last month's inflation. Our focus is on inflation within the horizon. There is nothing monetary policy can even do with this month's inflation, or next month's inflation, or even the September inflation. It's outside of the monetary policy horizon. And that's why you see us taking a view that takes you a few quarters ahead. And this time around, we also added quarters of 2029. And you say what had brought our forecast down? A number of factors. You might have realized that when we were at the May meeting, we had an oil price assumption averaging $91 a barrel for the year. And we now have $82 a barrel for the year. The rent had been resilient. We have got food disinflation that is actually taking place. We have already had a drop in the domestic price of fuel at the pump. You might have another one going up. It is very volatile. But that is the environment that we are operating in. And you said, what gives you confidence? Well, we have got to work with the information we have, and that is why we cannot tell you for sure what's going to happen. And we say, we will take every decision, meeting by meeting, depending on the data, the outlook, and the balance of risks to the outlook. That is the stance that we would take. And you said, well, and of course, I mean, that answers your second question. We have revised the headline inflation lower. And then you then raise the issue about core. Core is continuing to rise. We are watching that very closely, but we still expect core to peak at 4.1% in the first quarter of next year. And this year, we expect it to be just below 4% for this year. So that gives us the basis on which to move. You would also see in the statement we do refer to the other measures of underlying inflation. We have developed these other measures that determine what underlying inflation is, because there tends to be this narrative that says that, oh, it's because of oil, so you can do nothing about inflation. And says, okay, let us remove all these volatile prices and see what happens. So whether you look at the super core measure, or whether you look at the trimmed mean or the principal component, core component of inflation, common component of inflation, you will see that they are ticking up. But even as they are ticking up, they are not above outside of the tolerance bands, right? But we will continue to watch those. The important thing about all of those measures is that if they continue accelerating, it tells you that second round effects are starting to kick in, and you will have to calibrate policy accordingly. Services inflation has been an issue for us, but for a long time, for us, if services inflation was so contained, right? It is now beginning to rise, and a closer look shows that it is driven by medical insurance and other insurance services, but we think that you might actually be seeing housing and utilities also beginning to kick in. But still, services inflation is expected to just be just above the tolerance band. But overall inflation will be within the tolerance band and closer to 3% by the end of next year, and into 2028 and 2029, it should be bang on target. The next row.
Dozo Kumalo from Newsroom Africa. If you could please add a little bit of color to us on what shows that increasingly the municipal dysfunction is becoming a constraint on growth. Does that have to do with the equitable share transfers with help by National Treasury? What is giving the SARB that indication? Thank you.
Good afternoon. Thank you, Governor, and the MPC panel. My name is Ndando Tukwana from Bloomberg News. Governor, my question is around your policy stance and what you would need to see between now and the September meeting to prove that your policy stance is sufficiently restrictive. Thanks very much.
My name is Stella Mapenza, also from Business Day. Governor, at the BER conference last month, you said...
I don't see Stella. Where is she?
I'm here. I'm here, sir. You said at the BER conference last month that the bank had acted preemptively in May to raise interest rates even before the second round effects emerged, and that you were worried that waiting until they actually came into force would have been waiting too late. What has changed? What has changed since then in terms of your anticipation about what will happen with second round effects?
Good afternoon, Governor and Deputy Governor. Spalesa from CNBC Africa. Just two questions, Governor. Is the MPC comfortable with the level of real rates? To what extent do they feature in your final decision? And my second question is around the second round effects. In your previous meeting, you did mention that you were starting to see signs or evidence of second round inflation effects. Now, given the inflation print that came out yesterday, are you seeing any further evidence of these second round effects? Thank you.
Ms. Kumalo, the municipal dysfunction, we can't pin it down to anything. We are not institutional government analysts. What we do know is that it is constraining business and economic activity. What the source is for the government to identify what the source is. Suffice for us to say the big methods, there is dysfunction, and that dysfunction is constraining economic activity. You have heard of companies that relocate out of dysfunctional municipalities to try and find greener pastures elsewhere. We're just grateful that they can still find greener pastures in South Africa, and they didn't decide to seek those greener pastures elsewhere. Ntando, policy stance, there are a number of things that you could look at the policy stance. We believe that our policy stance is appropriate. You can look at what we call the neutral real rate, interest rate. And if the policy rate is above the neutral interest rate, real interest rate, we say that we are restrictive. And if it is below, we will say that we are accommodative. Put simply, the neutral real interest rate is that interest rate that is neither stimulatory or contractionary. As it stands, within the policy horizon looking forward, we are still restrictive. Less so than in the past, and the reason why it is less so is because the rise in inflation has been faster than the rise in the policy rate. And so that made us to be still restrictive, but less restrictive than we were previously. That is one. Two is that people also tend to look at the contemporary real policy rate, contemporaneous real policy rate. And they would say, oh, inflation was 5% last month. The policy rate is 7%, therefore the real rate is 2%. Not very useful because you are measuring the past. What matters is, what are the expectations of inflation within the policy horizon, that is 12 months ahead, 15 months ahead, and say, what is that stance? And that stance, we are still reflecting a positive stance. But this also links to what Kopano raised about what makes us think that what the steps that we had taken are going to have an effect on inflation, and what have we seen from the current print. I would be lying to you if I've just told you that we are looking at this over the policy horizon. If we claim victory that the stance we took in May had impacted on June's inflation, we will be being dishonest. By the same token, don't say you adjusted the policy rate in May and inflation has gone up. That means that it is not enough. No, there is a lag in the monetary policy effect. And Stana, you said that some chap spoke at the BER and said that the Reserve Bank is acting preemptively. Not me. I didn't talk about acting preemptively. I said we acted timeously. Very subtle difference. We acted timeously because we were seeing that there are indications that second round effects are beginning to kick in, and it's time for us to act. That if you wait until the second round effects are in the room, it is too late. And you will then be forced to act more aggressively than you would have otherwise had acted. That is what I was saying. I was not talking about being preemptive. And Palisa, the second round effects, I think that when I was dealing with the question about the different measures, we're trying to strip out things to try and see what is there in the price formation process that which indicates second round effects are kicking in. The easiest one has to do really with wage demands and wage settlements. As soon as the wage demands start to run ahead of the inflation, it says that the price setters in the labor market are saying that they are expecting higher inflation, and therefore you have got to nip that. The other, of course, is the pricing power of the businesses. And when you see businesses beginning to raise prices because of inflation, you are having an indication of second round effects. And again, remember that they do these things, and sometimes you might not even pick that they had raised prices until the next CPI is released. And if you again wait for that, you might actually be too late. So you're going to have to be exercising a lot of judgment in identifying those second round effects. Right. Alistair, yes, thank you.
Governor, the committee, thanks very much for taking our questions. I want to bring us back to digging into what you're going to need to see between now and September to encourage yourselves that you've got policy set right. Your forecast for CPI, headline CPI, in the third quarter, if I'm reading correctly, is 4.2. So, at the risk of sounding stupid, you need to see inflation trending in that direction in the next several prints. And if it doesn't, then that's going to increase pressure on you to do something in September, because if inflation stays high, your real rate won't be as effective, and you need to adjust. Is that sort of like a nutshell way of understanding? Thank you.
Kopano from Reuters again. I asked this question knowing that I could get in trouble, but I'm not...
I know there's freedom of speech.
And I'm just to preempt, just to say, I'm not the economist, and I know that the economists we survey are not the MPC. But they all expected a hike, given the uncertainty, especially around the volatility of the war and the MPC's history of taking a more cautious approach to inflation. So this time around, what was the bigger consideration? Was growth, the domestic growth, a factor in your consideration, or you're still waiting for the transmission of the previous hike and trying to see where inflation settles? I don't know, but yes.
I don't know why that would put you in trouble. Any others? Sarah, you want to have a question?
Yes, we have a question from Robin King from Central Banking. He asks, can you provide some detail on the thinking of the two MPC members who preferred to raise the policy rate?
Okay, that's the last question. Okay, Alistair and yes, Alistair. Looking forward to towards September. The question is not fundamentally different from the one Kopano asked earlier. And then so you said, would we be focusing on inflation going towards that peak that we had mentioned? And I'm saying to you that the peak is next year, is not this year. And you say, are we looking at that? Of course, that is what we are targeting. We always look at it. But we have also got to be looking at the underlying measures of inflation, because those are important. If you strip out the volatile ones, then what do you get? And the question about stripping the volatile ones is that these volatile ones, at times they also contract. So sometimes when you strip them, they actually show that inflation is going up. But there are times when you strip them, it shows that actually there aren't inflationary pressures. So we have got to look at all of this. And then, of course, we have got to look at other data. For us, we have got to understand what the extent of slack in the economy is. And the one measure of the preferred measure of slack for the South African Reserve Bank, which we use in our quarterly projection model, is, of course, the output gap. And that output gap is closing over the it is still negative in the near term. And we have seen, and that is consistent with the fact that we are actually seeing a demand that is weak. But then Kopano says, are you emphasizing growth more than inflation? We actually in a very difficult bind. The worst position for a central banker to be in is to have rising inflation and weak demand. because you do not have an instrument for one or the other. You have got the same instrument. And so where do you deploy it in that instance? And that is why you see this deliberate move. The moves that we are doing are not fundamentally different from the moves we were doing in 2021, where we were moving on 25 basis points and continuing to assess as we are going. The only difference this time between 2021 and now is the starting point. Whereas in 2021, we started with inflation above target, rising above target, and at the same time having the policy rate that was negative in real terms. This time around, we are starting from a point where we have got positive real interest rates. Inflation, before the shock was on target, the shock had come through. If we strip the effects of the shock, we are still not too far from 3%, but we decided that we have got to act because we are seeing indications that second round effects might be kicking in. And as we get towards September, we will get more data that will tell us whether these second round effects are coming in or not. And we would then, if they are coming in, we will calibrate policy appropriately. Rest assured that when we take a stance, it will not just be appropriate, it will be enough. Economists expected the thing. We are going to have a conversation with them. It's not a nice thing if you are an economist to get the call of the central bank wrong, because your bosses will ask you about it. But it is a dismal science that we are playing, and in this uncertain environment, you can forgive people for missing what they had actually expected. And by the way, it might just turn down the line that we were wrong, right? So that is the nature of the profession. But thank you very much for your attendance. I said that was the last question, so...
Sorry, Governor, we've got one final question online. It's from Artwald Lamini at Alliance News. He says, the MPC statement seems to suggest that the MPC expects the inflation to be temporary. Is this correct to assume? And how concerned is the MPC that geopolitical tensions could lead to more sustained higher inflation?
Geopolitical risks impact on economic activity. We are not very good analyzing the geopolitical risks. And even the geopolitical analysts are getting it so wrong. Even if they are on social media, they will still not get it right. The situation is so volatile. And with that volatile environment, it had introduced volatility in the oil price. As we were getting into the May MPC meeting, everybody was talking about this oil price going up, and we had an average of $91 a barrel. And then we got into June, there was some memorandum of understanding. The oil price dropped, and as a result, we revised the average for the year to $82 a barrel. And that feeds into the inflation outlook. The one thing that is certain, Atwell, is that uncertainty is here with us, and it is a forecaster's nightmare. Robin asked the question about the thinking of the other two members. If you look at the statement talks about risks to growth, risks to inflation, and it tells you the risks to growth are on the downside, the risks to inflation are on the upside. Our statement balances the views of the entire committee, of those who were calling for a change in policy, and of those who thought that we should keep policy the same. Thank you very much, and enjoy the journey to September. We will see you then.
Shark Flex Style, the powerful hairdryer that's always just a twist away from a versatile multi-styler. For every style and all hair types. For all hair kinds. Shark Flex Style.